On June 29, 2007, Apple reinvented the phone through its release of the iPhone, which sold 300,000 units over its first weekend alone and 1.39 million phones worldwide for the next year. Even with a 129% markup on Apple's flagship product, consumers flooded to Apple stores waiting in lines for hours, and in some cases camping overnight just to get their hands on the next best thing. Fast forward to 2020, and the iPhone has once again sat atop its throne as the best-selling smartphone in the world, even though technologically equal smartphones are available at a fraction of the cost. Apple has capitalized on the herd mentality through its marketing campaigns. The tech giant knows that its customers will continue to purchase their overpriced iPhones to remain trendy amongst their social peers. Furthermore, Apple maximizes the psychological narrative of FOMO, or fear of missing out. Very few want to be the one without when their social circle has the latest and greatest. Welcome to Crypto Psychology, where I discuss the connection between the neurophysiology of human decision-making and the cryptocurrency markets. According to Maslow's laws, there are 5 needs that humans strive to satisfy, the most paramount being the need to survive. In fact, our brains are hardwired to do everything in its power for survival. From the beginning of time, survival has been accomplished through the support and strength of the pack. All animals gain security by forming herds to protect the young and weak. Additionally, the corresponding support system allows the members of the herd to forge bonds and relationships within the pack. Humans are no different. Each person's pack begins at birth and influences choices and decisions of the individual members. This is the foundation of the herd mentality. The herd mentality describes how people can be influenced by their peers to adopt certain behaviors on a largely emotional rather than rational basis. This irrationality is rooted in the reward center of the brain. Dopamine, the feel-good hormone, is intricately connected with rewards. When you are expecting a reward for something, dopamine rises. Interestingly, assimilating into the pack belief also stimulates the reward center, thus releasing more dopamine into the body and resulting in the ability to feel better. Therefore, accepting the popular public principle makes you feel good, and we all want to feel good. Additionally, a study performed by Vasily Klecharev illustrates that when an individual thinks differently from others, our brain responds by triggering an error signal, thus not releasing dopamine. Furthermore, our brains register a kind of neural discomfort when they try to stand apart from the herd. Therefore, the individual who thinks for oneself and does not accept the herd mentality is essentially punished, and that conditioning is difficult to overcome in future decision-making processes. Unfortunately, this feedback loop of assimilation and reward can lead the public astray. In a study performed by the University of Leeds, researchers discovered that it takes a minority of just 5% to influence a crowd's direction, and that the remaining 95% follow that belief without realizing it. 5% influence 95% of decision-making within a crowd. Equity markets understand that human psychology drives trading decisions, and cryptocurrency trading is no different. Traditional markets are equal to cryptocurrency trading in the respect that human beings are behind the buy and sell orders. To illustrate the herd mentality, let's take a look at one example. Bitcoin's previous all-time high of roughly $20,000 hit in December of 2017 depicts irrational FOMO buying and the subsequent demise of Bitcoin's price in the bear market to follow. Beginning in September of 2016, Bitcoin started its ascent to its then all-time high at a price point of roughly $575. As you can see, each subsequent monthly close was higher than the previous, except for March and September of 2017. This meteoric rise of 3,486% gained traction around the world. Once October of 2017 was upon us, retail investors flooded into the markets as the mainstream media caught wind of Bitcoin's epic run, and all rational thought was quickly replaced with the hopium of riches beyond a person's wildest dreams as the market entered euphoria. Here is the euphoria stage that the market entered prior to the bear market in January of 2018. Retail-driven money catapulted the Bitcoin price in November, and the euphoria stage quickly consumed price action. As investors patted themselves on the back and started picturing Lambos for their driveway, a bearish engulfing candle was printed in January of 2018. This candle was then followed up with the doji candle in February, indicating indecision by Bitcoin investors heeding caution. Unfortunately, the herd mentality remains strong as YouTube influencers and figureheads within the crypto space continue to celebrate Bitcoin's momentous climb, thus fueling more people to buy at the top without rationally analyzing the technicals detailing a trend reversal in Bitcoin's price. Regrettably, for many who FOMO'd into the top of the Bitcoin's price action, the tidal wave of momentum surrounding the entire crypto space came crashing down upon the heads of the investors in March of 2018 as a bearish confirmation candle was printed, signifying the start of a grueling bear market, which lasted until February of 2020. Many believe that the current price action of Bitcoin and its subsequent influence over the entire crypto space is playing out exactly as it did in 2018. In a recent interview with Yahoo Finance, famed economist and Bitcoin bear Nouriel Roubini stated that people are moving into the crypto market because of FOMO, and eventually they'll get crushed. Nouriel's current position is caused by the herd mentality. People want to feel good with their investment choices, and the surge of dopamine that is released when a person agrees with popular opinion reinforces their decision-making process. At times, investment decisions based on another's point of view can work out well financially. However, as those who bought at the top in 2018 can attest, the same irrational thought can wreck an investor and result in the need for diamond hands to survive a potential loss as patience waits for a trend reversal in the crypto space. What can you take from this lesson in neurophysiology? First, understand that the herd mentality is ingrained in animal instincts, and we humans are no different than any other animal species. Therefore, do not invest based solely on the recommendations of a crypto influencer. Rather, consider the fundamentals of the project combined with the current technicals to gauge whether or not the current public opinion has any validity. Additionally, realizing that investment choices may be manipulated by the reward center in your brain can direct your positions and allow you to understand investment choices. So take a step back, allow your higher cognitive processing to advise you, and when in doubt, zoom out to provide yourself with the greatest investment choice option. Furthermore, going against popular opinion may cause some short-term discomfort neurologically, but the alternative may cause tremendous bliss over the long term if the market moves against public belief and sides with your position. Lastly, I will leave you with Warren Buffett's famous quote, "Be fearful when others are greedy, and greedy when others are fearful." Wise words from a billionaire and advice that on the surface may seem easy to follow. However, the reward center associated with the herd mentality makes the practice of such advice difficult to implement for many crypto investors. If you've gained value from this video, please hit the like button. Also, if you'd like to receive more content and how the brain impacts investment decisions, please subscribe to the channel. I will continue to bring you scientifically backed research relevant to the crypto space. Best of luck to all of you with your investment choices.